Alright, good day grade 12s. The third in our lessons on fixed assets is a typical grade 12 exercise where you'll see, like the one that's showing to you on the screen at the moment, where you've got a fixed asset note but there's a whole lot of asterisks around. And those asterisks have to be completed to start with at the beginning. And let's start by looking just at the land and buildings at the beginning. You're given some figures in the land and buildings, and you are told, well, in fact, you were told nothing. If you read the information, it's about vehicles, there's equipment, and there is nothing there about land and buildings at all. What you are expected to do is to see the figures and realize there's something taken place. So what is it? You had 1.2 million at the beginning, you had 1.3 million at the end, and so obviously it means that we have bought an extra 100,000. So you've got an addition over here of 100,000. I referred to this in a previous exercise where I said you've got to be able to see. This is where you are analyzing. No information given to you, but you can read from the figures that you've actually added on 100,000 during the course of the year. Sorry, I forgot to tell learners that have got the textbook. It's task 7.13 in the New Era textbook, irrespective of which version of the textbook you've actually got. Those of you who do not have the textbook, you're just going to have to work on a piece of paper or in your heads just working out these figures here. Now let's move into the vehicles. The vehicles, you are given the carrying value at the beginning and you're given the cost, but you're not given the accumulated depreciation. So the first thing you need to do is to calculate that accumulated depreciation. So do it and write it in on the sheet then. You can just pause the video while you work these figures out. You're then given an addition at 240,000. There's no disposal, and then there's a whole lot of asterisks. And if we look at the bottom, it says to the new vehicle was purchased on the 1st of July. So now ask yourself, which vehicle are they referring to at that stage? And it's obviously the 240,000 because they've told you that there was an addition. Then it says to you that, and vehicles are depreciated at 25% on the diminishing balance. So using the information you've got, I'd like you to complete the vehicles, find those missing figures there for me, and then we'll check them. Right, now the first thing you needed to get was the accumulated depreciation. Remember, 640,000 minus that figure, and that was the figure you didn't have, minus that figure gives you the 151,875. So you had to subtract those to get that missing figure of 488,125. Then you know the 240 was given to you, and so the next step we have to do is work out the depreciation. Now the depreciation will be on diminished balance. Now, the book value was given to you at the beginning of the year, times 25%, because that's what they're giving you. And then you bought a new vehicle of 240,000, also times 25%, but you've had it for 8 months. You bought it on the 1st of July. So you will include July in your calculation, and you'll work right up till the end of February. Now again, I've said this a few times, but please make sure you're getting these months right, otherwise your figures are going to be wrong. And so your depreciation, then another 40,000 on that, so you've got total depreciation which you can fill in of 77969. Absolutely essential that you show these workings because there's a lot of marks allocated to this figure. And if you just give one figure and it's wrong, you're going to be marked wrong. And then your cost at the end, you had 640, plus you bought 240, so it's 880. Your accumulated, you had 488,125, plus the extra depreciation to get the final figures, and you can balance it off. Obviously, there being no disposal, it didn't complicate those end of the year figures. Now the equipment will be a little bit more challenging. Besides missing figures over here, you can see that you've got to find your cost figure at the beginning. So it's a different interpretation what we did with vehicles. There's a disposal this time, and that's what's going to complicate it. And the depreciation, though, has been given to you. And it does say to you at the bottom, a loss of 2,000 was made on the disposal of all existing equipment which took place on the 28th of February, which was the end of the year. Now they're referring to the old equipment. So this old equipment now that you have now disposed of on the 28th of February at the end of the year, and then equipment is depreciated at 15% on cost. So just go step by step and fill in those figures. You are going to have to do a disposal, either just doing the figures, or if you want to, you can do a rough tier count to fill in. Right, so the first thing to find the cost figure, remember the cost which you don't have minus the 160 gives you the 40,000. So you can solve that thing and your cost was 200,000. You're told that you bought 180,000 extra, but you weren't told the year that you bought it on. But what you were told was a disposal. So let's deal with the disposal first. Now you can either do it as just writing down figures, or you can go back to do a rough ledger account like we did earlier, if that makes it easier for you to understand. Now I mean rough, so that's why I've used abbreviations and no dates and things like here. It says to you that we sold all the existing equipment, and the existing equipment which we had at the beginning of the year, the figure you've just calculated was the 200,000. Now remember that sheet that I gave you earlier in the where we actually worked out our different figures. Then the accumulated depreciation, which we were already given, was 160,000. But that was at the beginning of the year. We sold this on the end of the year, so we've got to work out depreciation, and it's 15% on cost. So 200,000 times 15%, and you've had it for the whole year because you sold on the last day of the year, and that equals 30,000. So the total depreciation is 30,000. So you've depreciated this by 190,000. Now there's your carrying value at that point in time. 200,000 minus 190,000, and so your carrying value is literally 10,000. Or you could have just done it as figures and said that the cost price was 200,000. The accumulated was 160 at the beginning that they gave you, plus you worked out the extra year of 30,000, 190, and so the carrying value is 10,000, and that's the figure that goes in there. That would be your challenging figure there that you have to calculate here. Now it's not necessary to complete the asset disposal because we actually because it didn't concern, the fact that we made a loss had nothing to do with this fixed asset note. Now, you were given the depreciation and actual fact of 30,000. So what we didn't know was that we did buy a new equipment and we didn't actually know what date we bought it on. And you will notice, just jumping slightly ahead, there is a question here in the book, and this is where you are asked to interpret. Explain why there's no accumulated depreciation equipment at the end of the year. Now let's just have a look here. Why is that 30,000 on all of this and nothing on the 180? Or if you have a look here, 200,000 plus the 180,000, remember that you bought, but you sold all this 200,000. Here it is here, you disposed of it. So you've only got 180,000. Your accumulated depreciation was 160 plus 30, which is 190, but you minus the whole 90 out because that was to do with the old equipment. And so the reason why there's no accumulated is that you obviously have bought this extra 180 on the last day of the year. There was no depreciation on it. The full depreciation was related to the old equipment over here. Alright, and there you can finish off that note. Now just looking at some extra questions, which is typical grade 12 questions. Although land and buildings are reflected at 1.3 million, which is what we were given here, a property evaluator estimates the value to be 2 million. Which principle of GARP is being applied? Well, That is the historical cost concept, that we are putting it in at the price at which we paid. And what factors would have been considered when the company decided to acquire another vehicle? Well, at that stage you'd have to come up with some of your own interpretations, and there would be various different things. Maybe you needed an extra vehicle because there was an increase in sales at this time of the year. Maybe this old vehicle was starting to give you a lot of problems. There was a lot of repairs, and so you wanted to get rid of it. Or maybe it was just getting old and you decided before it actually lost all its value you were going to get rid of it. It might have been involved in an accident, in which case the old one, although they didn't say that over here, but that could have been another option if you had disposed of it. But we kept our old one, but we bought a new vehicle, and so we may be just needing to replace because we are expanding in our business at this stage. Right, grade 12, as I said to you, you can see what I'm telling you. This is how more like a question that you would get. Now, there are lots of these examples in the textbooks, all the study guides, all the past papers, and you're pleased to focus on it, because fixed assets can come into paper 1, where it'll be a fixed asset note where you'll complete figures, or it could be a control thing, like where we are asked questions like number 4 as to why we did something, which goes a bit beyond the figures that are in there in paper 2.